Jeff, let's segue to your next article because you were just talking about markets. What do markets think about where we are in this transition from terribly down, terribly up, and now where are we going? And one of the key markets that we always talk about on this show is the US Treasury market. And one of those places where we can kind of get a sense, one of the many, of what's happening is the positioning of traders, speculators. And you talk about that in your article posted on the 5th of October at Alhambra Investments. It's called COT Blue, OMG, the 30s. Jeff, the 30-year US Treasury is at 1.58% as of yesterday. That's because the Fed is printing, the government is spending, and therefore the only place for bond yields to go is up.
Yeah, right. It's the shifting narrative, right? The original thesis was that it was really easy to get the V. You just turn everything back on, everybody goes back to normal. Now it's dawned over the summer that, okay, it wasn't so easy. Now we're going to need more government stimulus. And so supposedly everybody's happy that there's going to be more government stimulus in the the federal government's going to do something. The Fed might do more. I think the number was 3 trillion more QE, whatever. I mean, throwing around these big numbers when nobody stops and thinks, well, wait a minute, stimulus was already part of the first V narrative that, remember the Fed's QE, government spending, the helicopter payments back in April. These were all going to assure us that the original V narrative would work out. Now that it hasn't worked out, we're suddenly happy that stimulus is coming again. The governments are saying, oh, by the way, we got the first part wrong. Now we're going to get it right. I mean, it's what I call the QE2 syndrome. It's the idea that if governments and stimulus, if this stuff actually works, you don't have to repeat it. You don't have to keep doing it. But yet every time it's announced, certain segments of the markets, as well as almost the entire financial media, go nuts. They think this is absolutely fabulous stuff. But yet when they look at the markets themselves, especially the bond market, people say, well, wait a minute. Why aren't bond yields rising rapidly? Because they're supposed to be joining the same party that I see. The financial media is certainly happy about future QE and future government spending. Why aren't bond yields exploding upward? And that's really, that's where you get into this changing narrative and what's really going on with this quote unquote stimulus stuff.
Well, let's look at the Commitment of Traders report. And longtime readers and longtime listeners will note that you have kind of a back of the envelope kind of a measure, a rubric. No, what is that river that Caesar crossed? The Rubicon.
Rubicon.
If you cross the Rubicon, then things start to get serious. It's time that the business end of the plunger is going to be used. We're getting down to business now. And you've identified that in the Commitment of Traders report for long-term treasuries as 800,000. Doesn't have to be specific. It could be a different number. But once it crosses that mark, open interest, things start to go wrong. And so you're still seeing that. I'm pulling up the graph now. It shows long-term history.
Right. It's really open interest. Really just tells you how many contracts are open, how many are at any one time being traded on the market, or not even traded, but how many are existing and registered with the clearinghouse. And what you see is whenever you see these large amounts or spikes in open interest, it usually equates with bad things, which kind of makes sense, right? Because when you look at bond futures and what they're really used for is hedging. So you would expect that if things are going to be bad and the market starts to think, well, maybe there's some bad stuff out there, I might need to put on some hedges. One of the hedges, a popular hedge, and one that makes sense is you're going to be long, or at least in some manner participating in the treasury market, hedged some way against something that you perceive to be potentially a big negative. And it's pretty much, every time you see open interest spike, go back to March of 2020, for example, that big spike up to almost 1.5 million contracts in long bond futures. Again, the worst times bring out lots and lots of hedging. But that's usually the deflationary stuff, not the inflationary stuff. That's the bad stuff, the Eurodollar stuff that we always talk about. And so if the bond market is seeing this inflationary recovery, good times ahead scenario, at least in long bond futures, what we're seeing is a hell of a lot of open interest, which suggests maybe not. Maybe there's still lingering concerns, maybe not even lingering concerns, but really serious concerns about what the next quarter, 2 quarters in the future really do look like. Maybe it's not, maybe the stimulus stuff isn't really convincing.
But Jeff, does it matter? What is open interest? It's the number of market participants that are either long or short. So does that matter whether they're long or short, or who is long or short? Right now, as you mentioned in the article, we have record short interest by a particular group. So that's negative for bonds, no?
Well, yeah, and it matters who's doing what and where, because remember, these are markets, these are vast. There's all sorts of different players who have all sorts of different incentives to act in these marketplaces. Dealers, for example, most of the time, dealers, their interest is just to take the other side of a market because they're trying to match between a long or a short or whatever. And so a dealer might be in the marketplace long or short, and it has nothing to do with intending to be long or short. They're just making markets. And so when you get down into the details about which group is doing what, it matters what group is doing what at what times, but maybe it doesn't necessarily matter in which position the overall market is taking, because not all of the whole market is taking a position to take a position, to be specifically long or short. But as you mentioned, these leveraged money speculators, which are, these are a segment of monetary futures market participants who've identified themselves to the CFTC as leveraged money speculators. They have been absolutely, unbelievably, obscenely short the Treasury bond market, really going back to the beginning of this year, and it's gotten worse since around June. It's in a massive short position. And the reason is, I think, especially when you look at when that short position really started to materialize in June of 2019, these speculators are betting on the Fed, because June of 2019 was when the Fed said, yeah, we're not going to do rate hikes. We're not going to do rate pause anymore. We're going to start with rate cuts. And so ever since the idea of rate cuts have become more a realistic position than they actually happened, these speculative leveraged money positions have gone further and further short. Because remember, it wasn't just rate cuts. Rate cuts then became, after September of 2019's repo mess, rate cuts became repo operations. Then they became not QE. And then not QE turned into after March 2020, QE6, which was the massive stuff. And then all these other market support things. And so these leveraged money speculators, the more the Fed does, the more they short the long bond position. And that hasn't resulted in the long bond yields going up, the prices going down. Quite the contrary, because the Fed is never right. When the Fed is doing something, it's usually because deflation already exists.
Let me draw that out some more. In the graph that we're looking at right now on YouTube, we're looking at data that goes all the way back to 2010. And there are a few ravines here of traders going short. And then you overlay that with the US Treasury, the 30-year. And what do we see, Jeff, in the first two instances when quote unquote, everyone went short, compared to when everyone, their mother and their grandmother and their neighbors have gone short this time regarding yields?
Well, usually, there can be a temporary backup in yields, which is, is that necessarily the shorts winning the argument, or is that just the way the markets work? Because nothing ever goes in a straight line. But overall, what you see is that after these periods of massive shorting, yields tend to go lower. They tend to be lower after all, because the short position if I'm right, it's based on what the Federal Reserve is doing and taking a central banker's word, then that's always going to put you in the wrong position. And so it doesn't matter if shorts are shorting the market because they think Jay Powell will be right. Jay Powell's always wrong. And so that's usually what ends up happening. And when you see this massive short position in leveraged money speculators now in 2020 going to an obscene level, I would look at that and think, man, there's a real potential that the yields are going to snap lower once the short covering actually does start. Everybody's going to fly out of the short. They're going to have to start covering their positions, and there's real potential here that yields go way down for no other reason than short covering.
The thing that stands out to me in this graph is that after this deeply short positions previously, we did see some of the yields rising, but we don't see any of that despite everyone else ever piling into the short position this time. It seems as if we're in a depression, deflationary sense. And that's how you ended the article. You said, quote, bottom line, yields can and maybe even will go higher than where they are now, but that's just markets. It's not even reflation, and you can forget inflation.
Yeah, it's the broader market position beyond leverage money speculators, because I think there are a lot of market participants, even in the futures market, who are saying, I'll gladly take the other side of your short trade. I'm happy to do it. I mean, you want to give me free money, but betting on Jay Powell, I'm more than fine with doing that. And I think that's why you've seen yields kind of move sideways in a very narrow range, a suspiciously narrow range, because even though leverage money players are short, everybody else is saying, we're not betting on Jay Powell. That's a losing bet. I mean, look at where rates are now. Supposedly inflation, treasury market crash, bond routes, all these, we've been hearing about these things for over a decade, and they never happen. And the reason they never happen is because the central bank is all smoke and mirrors. It's a puppet show. There's nothing real there. So, getting into the context of what we're talking about here, the shifting V narrative, what used to be, hey, it's really easy, everything goes right back to normal, and stimulus is going to guarantee that, to now, well, it's not so easy. It's not going to go right back to normal, but stimulus is going to help. I mean, it sounds absurd. It sounds insane. Stimulus didn't work the first time. Now we're admitting it didn't work the way we thought it was going to work, but that's supposed to now lead us into the promised land. The same thing that didn't work is going to, again, I call it QE2 syndrome for that reason, because back in 2010, it was already clear things weren't going the right way. And if you had to do a second QE, obviously it's because the first one didn't work the way you said it was going to work. And that, to me, is a different realization than what takes place in most, obviously the stock market and other places, especially in the financial media, where stimulus is always talked about in the most glowingly positive terms, as if this is all just really good. When you step back and look at the last 12 years of labor market shrinkage and everything else and say, it didn't work. None of it worked. It never works. It never does what it's supposed to do.
Jeff Snider, Chief Investment Officer of Alhambra Investments. You can find him on Twitter at JeffSnider_AIP. You can find him on Real Vision, which was a 90-minute interview with Steve Van Meter this week. And also you were on Dr. Dark's podcast, and so people can listen to you there as well.